Hello and welcome everyone to the Manulife Investment Management Asset Class Outlook webinar series. We would like to give you a quick couple of housekeeping points before we kick off. For those of you who dialed in today, we appreciate you stay on mute throughout the whole session. And for those of you who joined via the webinar platform today, please do submit questions during the webinar. You can do so by submitting questions below the screen. We will endeavor to address as many questions as we can towards the end of the presentation. Our speaker today, Hui Min Ng, Portfolio Manager, will explain the fundamentals of Asia Pacific REITs and the outlook of this asset class. Over to you, Hui Min.
Thank you. Good morning, everyone. Thanks for making time to join me for this webinar this morning. I hope you and your loved ones are keeping well and healthy in this extraordinary and difficult time. With this unprecedented and unexpected global pandemic, where half the global economies are now in hibernation, financial markets have taken a very bad beating across all asset classes. Despite Asia Pacific REITs being beneficiary of the aggressive monetary loosening policies, they were not fared as well, as investors are highly uncertain about the future economy, how it will pan out. Current situation remains highly uncertain and is rapidly changing across the key economies that we invest in. However, it's still very timely for us to go back to the fundamentals of REITs and how we should pick the best quality ones to ride through these uncertain times. By regulatory obligations, REITs by feature have to pay out at least 90% of their earnings to shareholders to enjoy tax transparency. This income feature over the past decade has provided a buffer for investors when markets tend to move lower, and as well as enhance total returns for investors when markets appreciate. Indeed, this year will be an unprecedented year as government encourages and requires most of stakeholders to share the pain for the economic downfall, especially with tenants in the retail as well as hotel properties. There could be temporary 1 to 2 disruption in distribution income for REITs this year in certain segments, but on a medium term and a full year basis, most REITs will still try to adhere to the high payout ratio of 90% of their earnings. If you look at the current headline yields of the Asia REIT market, the key REIT market are offering investors yields in excess of 6%, and this is much higher compared to the broader equity market, as well as the REIT free rate or the government bond yields. These high headline yields reflect market or investors pricing in uncertainty over the income and distribution for the listed REITs, and a lot of negatives have already been priced in and factored into the share prices. On a risk-adjusted total return basis, if we take into account of the March and February steep sell-off across equities markets, the Asia Pacific REITs still offer you an attractive risk-return profile on a 3-year basis. This compares well with the other global equities and global REITs, and it's only second to U.S. equities, which has still remained a top position in terms of risk-adjusted returns. If you look at the yield spread, which is a key metric for investors, be it investing in REITs or investing in real estate hard assets, yield spread has widened very significantly on the back of 2 key points. One is you can see that the government bond yields have actually dropped more than 50 basis points across a lot of markets, as a lot of central banks have started to cut rates very aggressively in this global pandemic episode. The second reason for yield spread widening has been, of course, the sharp correction in share prices, leading to yield spreads trading above their historical average. If you compare to December, that's 3 months ago, yield spread has widened almost 200 basis points in a lot of markets, and this yield spread currently is actually more than 1 standard deviation if you look at a longer history of more than 10 years of how yield spreads have traded at. Historically, normally, Australia's yield spread has been below 300 basis points in history, and in Singapore, it has been 400 basis points or lower in terms of yield spread. So in a normal world post-COVID, these yield spreads are very key attractive feature in a low interest rate environment, which is likely to stay longer when income and business normalize after COVID. Focusing back on a normalized scenario in a low rate environment, Asia REITs have held up well in terms of performance versus the broader equity market. While near term, income and stock prices for the REITs might take a hit from negative government orders relating to social distancing or malls closure, structurally and fundamentally, it remains a sector to own when economies recover post this episode. In late February, early March, with the collapse in oil prices, a lot of attention has shifted to balance sheet strength of the REIT, as people is seeing a kind of liquidity squeeze as well as credit freezing. Fundamentally, we believe Asia REITs are in much better financial shape versus the global financial crisis back in 2009, where it was a banking and credit crisis and a systemic risk versus currently, which is more on an economic slowdown. If you compare to past 2008, 2009, REITs in Singapore has structurally much lower gearing of less than 40% versus back in 2008, where some of the Singapore REITs which were having gearing in excess of 40%, and over 40% gearing was very common in Australia as well. Now, and if you compare it to the GFC episode, during back then, a lot of the REITs in Australia and Singapore has a high percentage of debt that were due for refinancing in a single year. This is not the case now, with very manageable refinancing requirements in a 6 months to 12 months forward view. A lot of the REITs in Australia are structurally much lower gearing at less than 35% versus back in the GFC level where they were sitting above 40% as well. As I have shared on numerous episodes, numerous presentations, a lot of the REITs have locked in longer dated debt with longer debt maturity profile, and they have very diversified funding sources versus during the GFC days, where we see a lot of REITs tapping into the CMBS market, which actually couldn't refinance their debt when those debt need to be rolled over. And the last point is, all the REITs are having very comfortable interest coverage ratios currently to withstand any near-term shortfall in income, and that would mean that they would not run the risk of running into debt covenant breaches in the short term. In this volatile time, it's much more important now than ever to focus back on the fundamentals of each REIT, to assess and pick names that will be able to ride through this difficult time and recover faster when COVID retreats. We have always looked at both qualitative and quantitative aspects of each REIT, which is very important, and we believe the number one criteria now, apart from strong balance sheet, will be very strong pedigree or parentage of the REIT. Each REIT's tenant profile as well as lease structure is also very important for investors to assess to impact on any potential loss of income due to tenant vulnerability or increase of bankruptcy risk. There have been constantly changing government policies, be it in terms of the code of conduct between landlords as well as tenants to help save jobs as well as to help maintain a high occupancy rate in a lot of buildings when things recover or back to normal. So it's very important to go back to the balance sheet strength. How can a REIT withstand certain loss of income in this difficult time, and how diversified are the tenant profile, and how vulnerable or how exposed a certain REIT is exposed to a certain segment, be it the small middle enterprises or small tenants which have higher risk of cash flow problems and are unable to pay off their rental currently. So with that, I'll be happy to take any questions.
Thank you, Hui Min. We see some questions coming up now, and there is a number of questions here. So the first one, you mentioned earlier that actually in the presentation that a lot of different industries are also sharing the pain for this COVID-19. Do you see any rent relief programs that could perhaps meaningfully impact the REITs bottom line? What is your view on that?
I believe the common stimulus measures being announced by across the key economies that we invest in has been focusing on saving jobs and containing unemployment. So we have seen very aggressive job keeper package from Australia, as well as cash handouts in Singapore and Hong Kong to people out there to keep employment high. And in terms of rent relief has been stronger in Singapore, where the government in the few budget announcements that they are giving out 100% property tax rebate to sectors that are worst hit. That will be the hotel, that will be the retail sector, and the industrial as well as office rent. Landlords will pass on a 30% kind of property tax savings and rebate to the tenants as well. Apart from the government measures, the landlords themselves in Singapore have also offered to rent relief for 1 to 2 months for their tenants to ride through this difficult period.
Sure. There has been talk about landlords offering rent rebate to tenants, and how would this affect or impact the income and DPU of REITs?
Okay. Currently, based on current situation, the most impacted segment within REITs will be the retail sector, as government has ordered a lot of non-essential services to be closed, and also social distancing and no dining in restaurants outside. And if you look at across the Asia REIT, retail definitely in Singapore and Hong Kong, in Singapore and Australia, will be affected more because there was also a government new bill, there's a government new code of conduct, such that tenants are able to defer payment of their rent for 6 months if they can prove that they were severely affected by COVID-19. And
okay.
And on a ballpark, if you look at the pure 100% Singapore retail REITs in Singapore, where they own 100% retail malls, every 1 month of rent rebate or rent relief that they provide to their tenants, it can be up to 10 to 15% impact on their bottom line or distribution income.
Sure. Okay, there is another question here. So the correction of Singapore REITs have been significant. Do you think that? I'm sorry. So do you think that the market is pricing in some recession concern here?
Definitely. If you look at how across the REIT market, Singapore and Australia, where a lot of REITs have dropped maybe close to 30% year-to-date basis, they have actually factored in a large quantum of loss of income from the REITs. But if you follow the sector very closely, it's not all the sub-sectors will be very hit equally. Even in retail malls, it's not all the tenants will be hit. Your necessity shopping, your supermarket and your pharmacies, these are not expected to be given any rent relief because their business are actually doing better. And of course, in other sub-sectors like your industrial REIT or some of the office REITs that have higher exposure to your blue chip tenants and less exposure to small SMEs, those are able to hold out in terms of their rental income as well. And of course, industrial REITs, a lot of them do hold longer dated lease structure and agreement. And the industrial REITs that own logistics assets and data centers will also be not affected in terms of rental rebate or relief, given that the business of their underlying tenants are actually more defensive and resilient in current times.
Okay, there is another question here, Hui Min. So millennials mostly shop online now. So post-COVID-19, where this may change on how consumer will spend on retail shops or malls, how would that affect REITs?
I believe if you look at Australia market, definitely Australia has seen an increasing size of online shopping, and the retail REITs are also seeing slowdown in terms of their store sales. But if you look at even Singapore or Hong Kong experience, in terms of retail space per capita, per square foot, we are actually much lower than the developed countries like US or even Australia. So if you go back to the fundamentals, I don't think Singapore has an oversupply of retail space per square foot. If you look at it comparing to the markets like US where there's a high percentage of online shopping. Secondly, if you look at the past months of consumer behavior, people in Singapore tend to want to go back to their neighborhood malls when they see that things are normalized. That was what we saw back in early March when there was some traffic recovering, going back to the malls when the number of cases show some stability. Of course, right now we are not allowed to go back to the mall, but I would still think that in terms of socializing requirements as well as the light to dine out, these trends will still remain highly relevant post-COVID.
Thank you. There is another question here. So how much could the online services, for example, food delivery, help when it comes to the retail segment?
Currently, if you look at based on what we see in Singapore right now, I don't think online delivery can help a lot in terms of the F&B or the restaurants currently. Even in my neighborhood, I believe a lot of the F&B restaurants have decided just to close down instead of just on doing a lot online delivery because there's no volume to support to pay off all the bills and then the staff costs currently. So I don't think it will materially change the retail consumption pattern.
Okay. There is some questions about the outlook. Which REIT sector actually will benefit from this growing e-commerce trend?
Definitely those sectors that will enjoy the e-commerce trend will be those that own the logistics and warehousing assets. That's what we see in some of the industrial REITs in Australia, where one of the REITs have actually have Amazon as one of its top 10 tenants. The other sector that could do well is REITs that own data centers, because we are in an environment of 5G being rolled out across the world, and the data consumption, the cloud facility that a lot of people require continue to fuel demand for real estate assets in this segment.
Okay. There is another question here regarding the yield of Asia Pacific REITs. How attractive is the current yield spread of Asia Pacific REITs, and do you expect the yield spread expansion would continue in the second quarter? Following the first quarter market correction, which markets or sectors now offer better opportunities?
If you look at the yield spread for Asia, particularly in Singapore and Hong Kong, Singapore and Australia, where we have a longer history back to 2008, I believe the yield spreads now are more than one standard deviation above average, which shows that a lot of negative has been priced in. Now, whether the yield spread expansion will continue or not is a bit hard to commit currently, because as we know, every week we have new government orders that come up, be it the shutting of malls, be it the forced rental deferment and waiver kind of a bill that the government roll out to help save the small businesses. So it's very hard to comment because the situation remains very fluid. But if you're saying there's no more new negative measures coming out from government, or any extended lockdowns that will go beyond 2 months to 6 months, then that will have an impact on the yield spread as well.
Thank you. Hui Min, we got time for one more question here. So some central banks have asked the enterprises to stop distribution of the dividend to shareholders. Do you think REIT sector will further be affected, being requested to cut the dividend payout?
Okay, currently by legislative design, REITs have to pay out 90% of their earnings to enjoy tax transparency. Because of the government orders currently, let's say in Singapore case, where the government is asking retail landlords to defer rent for hard-hit tenants for up to 6 months, that means there will be some cash flow mismatch between what the REITs can pay out to investors as what they book in as accounting profit. So currently for retail REITs in Singapore, they could take the decision that they might not pay out the 90% on a quarterly basis. Say for second quarter or third quarter, should they see a material drop in income because they could not have any cash flow coming in from rent relief or rent deferment, they will cut the payout ratio in the interim quarter. But on a full year basis, they are still required to stick to the 90% payout ratio minimum to enjoy tax transparency. Now, if this situation was to deteriorate, where the lockdown lasts 6 months, then I would say retail REITs in particularly may have to take the decision to withhold their distribution income and not pay out as dividends, such that they want to conserve cash for any debt payment or any interest payment due for the full year. What the REITs Association in Singapore right now is appealing to MAS or even the government to help that if in the event they were not getting any cash flow from the tenants, they are able to freeze their payment to the bank or even waive any debt interest coverage requirements or any debt covenants currently that they are obliged to stick to. So these things are still fluid, subject to what the government is coming up with in terms of policy response to the new bill or the new code of conduct of deferring of rental payments by tenants. This is specific to Singapore market.
Yes, thank you. Thank you, Hui Min. We're going to end here. For some questions that are not answered in these questions, our sales team will follow up with you later. We appreciate everybody's time to join the session today, and thank you once again. Goodbye.
Thank you, everyone.